From Barangaroo Studios, the ausbiz COB is the key stuff you need to know about the day in business and finance.
Well, hello, and welcome to the COB on this Friday afternoon. I'm Nadine Blaney.
And I'm Juliette Sarli. We have seen some positioning, I guess, or unwinding of positions heading into the weekend. A lot of factors there. I mean, if you've got this concern about what's happening in the Middle East, Israel, of course, saying the war is not over despite the alleged killing of the Hamas leader. A lot of uncertainty as well with China's stimulus. We just had their data dump. So you can kind of see why people are taking profits here.
Yeah, it's really interesting. So our market has sort of gone from bad to worse, down by about, 0.7% for the SIBO Australia Index. I can see the S&P ASX 200 down pretty close to a percentage point. But I do note that Japan's Nikkei has erased its gains. So it's going to be closing relatively flat. So you have really interesting dynamics going on out there, Juliette. Against a backdrop, I had a chat with Junbei Liu from Tribeca Investment Partners and Adam Dawes from Shaw Partners today. They're both really bullish on this market and the change in sort of leadership that is likely to come, even if after that jobs data this week, just yesterday, means that the RBA isn't going to be cutting here locally until even, mid next year. So
yeah,
interesting.
I think Scott Phillips said a similar thing to Andrew this morning, we're here. Where is everyone? Why are people not, taking advantage of this market that might actually start to move?
Yeah, I think part of it might be insofar as the fact that everything seems really expensive. Those big, well-known sort of tech companies, for example, really expensive. Pro Medicus, very expensive. WiseTech, very expensive. So perhaps no surprise we see a bit of profit taking today when we're so close to those record highs. And also when some of the data has been disappointing.
Yeah, absolutely. And I was talking about that with Dylan Wu from Pepperstone and also Steve Gopelin from Scanda FX before, as we had that China data dump coming through. Now, Flight Centre was the stock of the day today. Turbulence ahead here.
Yeah, and perhaps sort of across the travel space, as we learned, we started this week with a 30-something% drop in Webjet and continued to sell off in the days that followed. Adam Dawes, again, name dropping, saying that he's actually been talking to clients about trimming some of their Qantas exposure as well, waiting for that sort of next shoe to drop. So we'll get to the stock of the day, which was Flight Centre, in just a bit.
Just a quick look at those mining players, though, amid this concern or the data disappointing, the weakness in those iron ore players. Fortescue down another 2% today. Energy, we're talking about as well, as we remain unsure what can happen in the Middle East over the weekend.
Certainly, but it's not just, the miners and the energy names. All sectors were into negative territory today, so that included the banks. Overall, unless something has changed, like in Japan, just in the past little while, they were mostly negative, although CBA, you can see, up by 0.75%. Utilities were down, the discretionaries were down. APA Group off a pretty punchy 6%.
Well, let's just quickly have a look as well at some of those stocks. We've got Shane Oliver on the line, so we want to get to him ASAP. But Flight Centre, of course, hitting that 10-month low after flagging a dismal first quarter profit rise. We also had Harvey Norman making news today.
Yeah, ASIC has ruled against Harvey Norman and Latitude, saying they misled customers. Interesting story about Regal Partners, saying that South Korea's financial watchdog has indicted Regal Funds Management and one of its ex-employees over breaches of the country's short-selling laws, but not impacting the share price there, up by 0.8%. Bit of a power outage at one of BHP's copper mines, and into the energy space, another quarterly coming through, this time from Beach, quarterly production at 5.2 million barrels of oil equivalent.
Atlas Arteria pushing further into France as well, and Telix, an interesting one. Remember that it had shelved plans to list on the Nasdaq. Well, it's going to do that, but this time not capital raising. Charter Hall also sweetening its offer for hotel property investments. But let's get to the man of the hour.
Shane Oliver, AMP Chief Economist, joins us now. Shane, it's Friday afternoon. The market is closing down. What do you make of this week? What's top of mind for you?
That's an interesting one. I think, a bunch of things. It was a relatively quiet week, somewhat mixed. US shares are up, other markets down a little bit, our markets up a little bit. Obviously, earnings season kicking off in the US. I guess the big thing locally, of course, was a couple of big things. One is obviously the ongoing drip of lower inflation numbers. We're seeing more countries have their CPIs below 2% now, or if not, in the case of New Zealand, back within the target and close to 2%. So we've got Europe, we've got Canada, we've got what was the other one in there? It got down to 1.7% through the last week. So New Zealand 2.2%, UK
Yes.
1.7%. So of course all their underlying rates are slightly different. But they're all heading in the right direction, so that's good news. We've got the ECB cutting interest rates, Thailand and the Philippines cut interest rates in the last couple of days. So that drip feed of lower inflation globally and lower interest rates continues. And I think that will have an impact on Australia, even though we're lagging a little bit. But obviously the big debate in Australia is the jobs figures. They were very, very strong when they came out yesterday. That's good news, but it could be a case of good news is bad news if you've got a mortgage, because strong jobs and low unemployment could delay the RBA. But there is an interesting argument there that, what do Australia, the UK and the US all have in common? They've all got unemployment around 4%, but the US and the UK have seen wages growth slow down and inflation slow down. So that's not necessarily a barrier to lower interest rates, and both of those countries cutting interest rates as well. So maybe low unemployment may not necessarily stop the RBA from cutting, but the likelihood is that they could require a bigger hurdle in terms of lower inflation numbers when they come out in the next few weeks.
Shane, it's interesting, and I think you've kind of answered this, so you don't need to react, but I just was speaking to Paul Bloxham from HSBC earlier in the week, and he was saying that he thinks, and this was before the jobs data, and I saw him quoted saying this again, that maybe the RBA doesn't even cut by the time the Fed has finished. I think you're going to be saying that's not the case. So let's instead talk about the concern over what's happening in the Middle East, particularly given that Netanyahu has said today that just because the Hamas leader has been allegedly killed doesn't mean that all bets are off or that there's going to be a ceasefire now.
Yeah, that's right. It doesn't necessarily mean that that's the end of it. We've seen the leader of Hezbollah was wiped out a few weeks ago by Israel, and yet the war in Lebanon continues. So I can understand where he's coming from, but by the same token, I think the rest of the world would probably prefer a bit of a ceasefire and a bit of calming down for a while to let some of the dust settle. To see what's happening in the Middle East. But I think the key in all of this remains oil prices and disruption to oil. So if you're just watching the news, it's all shocking, it's horrible. But if you're an investor, you have to think about what it means for global oil prices. And so far, there's no disruption. And the good news over the course of the last week was Israel reportedly telling the US that they're not planning to attack Iranian oil and nuclear facilities. If that is true, then that's a positive, and that's why the oil price has fallen back below $71 US dollars a barrel on the West Texas, a bit higher than that on Brent. But that's why it's fallen back, and that's why it's sort of off the headlines in terms of market-making news at present. So if that remains the case, then that's good news. But I have no doubt that unfortunately the war in Gaza will continue for a while yet, despite the death of the leader of Hamas.
Shane, look, when it comes to share markets, we've seen record heights achieved here locally. There's been a lot of commentary that this is an unloved bull market, probably because there's lots of pretty XE stocks out there. What do you see between now and the end of the year in terms of the index?
Well, I thought your point was well made there. That is one reason why people are a little bit sceptical, because market is somewhat expensive, and there's I think that what the historic PE is 20 times and the forward PE is somewhat similar. So that's relatively high historically. And of course, if you go to the US, it's even higher than that. But of course, they've got all those tech stocks in there. So when you're that close to the end of the year, we are coming through. We're halfway through October. October can often be a volatile month. Some people used to call it a bear killer month. If you've got a bear market, it often ends in October. So we can still see some more volatility, but we are coming into seasonally stronger months. November, December, January traditionally stronger for markets. The direction of interest rates is still going the right way. It's down, maybe not in Australia yet, but globally it is, and that ultimately augurs well for us. So my view is, yes, they will be cutting rates here. It's just a question of when. I agree. They may not end up cutting as much as the Fed, but that will have to be seen as to how that pans out. But I am optimistic that we will get rate cuts here. But globally, anyway, that will continue. So that's a positive, and it therefore holds out hope that if we do get any slowdown in growth, that stronger impetus will be coming down the track as a result of lower interest rates. So I tend to think that the broad direction for the market is still up from here. And I take heart from the fact that it's sort of unloved, because bull markets usually end when they're overvalued. Well, you could argue we've got overvalued markets when they're overloved, but I don't think the Aussie market's overloved by any stretch. I think there's a lot of scepticism around. And interestingly, our sentiment aggregate globally is around average. It was in overloved territory a while back, but it's fallen back into around average. And the other thing you look for is technically overbought. I don't think we're technically overbought. You could argue maybe on the RSI a bit on the high side, but not dramatically. So those things would suggest to me that we probably keep going higher. Now, an obvious uncertainty in all of that, putting aside the Middle East, is what happens with the US election. If Trump wins, and the odds are sort of going his way at present, and some of the polling, particularly in the battleground states, have him ahead. But if he wins, you could get uncertainty around potential for a trade war, which I think would almost be inevitable under Donald Trump, whether he's just using it for maximum pressure or not, using the tariffs for maximum pressure or not. You'd still get a rough patch on the interim. But of course, markets might sort of initially think, well, last time US shares went up in 3 of the 4 years that he was president, he's talking about lower taxes, deregulation, those things are positive. So if he does win, you can get an initial rally out of markets, particularly in the run up to early next year. So my view would be we'll probably end up higher than we are now. That's not to say we won't have some rough patches along the way.
Now, Shane, Nadine and I were talking earlier about how much we love your weekly note, not just because it covers all those macro themes you just talked about in the market, but that there's always something interesting in there. And today it was about fertility. I have to say, as someone who lived in Asia for nearly a decade, the fact that we don't have the same childcare that you have in some parts of the world that is more accessible for people to go back to work. I mean, cost is a major factor, but what else is behind the fertility decline, do you think?
That's a good question. It was funny when you started talking about that. I thought you were going to talk about Copacabana, which for some reason I've got that song stuck in my head. But anyway, after the events of the last week around the Prime Minister. But just on that, I'd much rather go to Ipanema than Copacabana in Brazil. But in any case, on the fertility rate, I think there's a whole bunch of factors behind it. When you look at the ABS chart, it's been falling since about the time I was born. In fact, the year after I was born, when it peaked at 3.5 times. My parents had 2 kids, not 3.5. But and a long-term slide. Initially, part of that slide was because women were delaying having children into their 30s. But that seems to have run its course, and that might have been that catch-up effect as those women hit their 30s, and may have been responsible for a slight pickup in the fertility rate in the late 2000s, at the time of the baby bonus. But one of the big factors, of course, has been declining birth rates for teenage girls, and that's probably because of better birth control and a whole bunch of things around that. But I think a fundamental trend is per capita income. As countries get richer, more opportunities for women, less infant mortality, lots of other things to do rather than just have big families. And so that's a factor, and that's why you're seeing a downtrend in most countries, which go from being less developed to more developed. But the other factor, of course, in Australia is around that. If you're a woman or just a couple, you work out there's lots of things you can do in your life, lots more things that you can do in the 1960s, particularly for women, many more career opportunities. But if you go down that path, childcare is a big issue and a big cost. And so the perceived cost of having children has gone up. So you've got lots of opportunities in terms of things you can do in your life beyond just having children. And, of course, the cost of having children, or the perceived cost, has gone up. Childcare, housing costs, You might think, maybe I can afford a 2-bedroom unit. I'll just upgrade to a 3-bedroom unit. You look around, there's virtually no 3-bedroom units out there. And then if you go up to a house, they're a lot more expensive. So that's sort of getting in the way as well. And I think you can make an argument that maybe Peter Costello's baby bonus worked in the late 2000s on Gen X because the concept of the nuclear family was alive and well back then. I don't think it would work as well these days with Gen Z and younger millennials. The nuclear family is sort of an artifact of history, and I don't think they're going to be of the mind to suddenly think, okay, well, he's going to give me a couple of $1,000 or $5,000, whatever it is, I'll go off and have some more kids. Yeah, but I do think that if you made childcare cheap, it would probably help. But I'm also conscious that lots of countries have been trying to do things, whether it's China, whether it's South Korea, lots of countries in Europe trying to do things to arrest a declining birth rate or fertility rate, and it hasn't worked. So I'd be a little bit sceptical of the ability to turn that trend around or push it back to that 2.1 level that's often seen as the replacement rate.
Yeah. So fascinating. We could talk all day about this, but we won't. We'll let you go, Shane. What did you say? Ipanema rather than Cabana?
Ipanema, yeah. Coca Cabana. Don't get that song in our head. Well, it's done. It's an earworm. Thank you, Shane. Have a great weekend. We'll see you soon. Yeah. All right. Flight Centre was the stock of the day. Junbei Liu from Tribeca Investment Partners. Adam Dawes from Shaw Partners. Take a listen.
Essentially just saying, first you're saying that there's no guide. Well, you're not sure what the 2025 might look like, and there's so much volatility. And then you're saying the second half is going to be heavily weighted. So that simply means the first half might be terrible. And then what confidence do we have when we move to the second half? So I think this is a challenge. And then the thing with this stock, with Flight Centre, they often do this. So they often disappoint on some of the, guidance they put out there. 3 months ago, they were very bullish out there saying the corporate travel and everything's doing very well for them.
What you want with these big days and these big drawdown days is you want that stock to start to flatline a bit. It just move a little bit sideways, just so that the buyers and the sellers are somewhat meeting in the middle somewhere, and that gives you the opportunity to get into this thing. At the moment, you're going to catch a falling knife. I don't see a V-shaped recovery on this share price. I think this is going to take some time.
So that was put in the double buy category. So it will be going to the investment committee toward the end of the month. We know that Flight Centre was one of the laggards. Let's check out the leaders to start on a positive note. Perpetual, there's Telix, after saying that it's going to look for that US listing. Beach Energy in the wake of that quarterly production report. IDP Education and Ensel.
And having a look at where we saw the laggards, as we know, Flight Centre, and it kind of dragged down some of the others in the space too. Corporate travel down 10%. Star Entertainment had a good boost yesterday after we heard that it would be able to retain its Sydney licence, but back to being sold off today. APA Group and AMP also under pressure.
Yeah, just giving back some of yesterday's gains, I suppose, there for AMP. Let's take a look at the small to mid-cap space. We'll just go through these quickly. Quick Potty's a good one on a Friday, I think, but all in the resources space. So that tells you quite a bit there, and the Wagner's Holding Company.
And of course, looking at what is on overnight, we have the housing starts and building permits data out of the US, also some earnings from Amex, Procter & Gamble, and UK retail sales.
Yeah, I was reading a note from Westpac actually saying that retail sales will likely be a bit subdued because apparently it was very wet and rainy there in the month of September. Next week on Monday, we've got the Deputy Governor of the RBA, Andrew Hazard, speaking. He's speaking at a CBA event, and we've got purchasing managers indices coming out, payroll, we've got detailed labor force, and the RBA annual report. So no real sort of top tier data, I wouldn't say, here locally.
Yeah, but next week, of course, across the globe, the 1 and 5 year LPRs in China, the FOMC beige book, and some of those global PMIs as well. So just more fodder for the Fed, if you like.
So as we finish this session, we are digesting that data from China that was pretty weak, although some are now saying that it's likely bottomed out. We saw...
Oh, I just wondered if you needed me to rescue you.
Oh, no, thank you, my dear. I've just got a persistent tickle in my throat today. Jules got my back. But look at this. We did lift off the lows of the session into the close today.
Yes. And we finished the ASX 200 for the week, just off, of course, those highs reached earlier in the week. 82.83 is where we sit. 0.9% over the last 5 days. The ASX 200 up 0.8%. So we will call that a good week.
I'm going to call it a good week. Yeah. And there were lots of interesting stories. So again, we're in sort of a mini reporting season now with these AGMs. So you'll want to keep us on throughout the week and next week and catch up with what you may have missed over the weekend on ausbiz.com.au.
Have a great weekend.
We'll see you Monday.